I've lost $1 million in real estate, guys. That's part of what gives me the street creed to sit up here and give you an opinion is because I've lost money and I've gained money, and I've gained more money than I've lost. It's like playing baseball, right? You want to be able to make more money than you've lost. And so if you've lost money in real estate, that is not a reason to stick your head in the sand. It is not a reason to give up. It is not a reason to decide you are a loser big time and you should just stop. It's a chance to double down and really test your inner metal in who you are as an investor, because we're here for a reason. We're here for the possibility of what real estate can bring us. I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. There we go. So economic update. So here's the gig. So I'm going to try to fit in about 45 minutes, what normally takes about an hour and a half. So what that means is that I've highlighted particular information. I spent some extra time last night. I was telling Deborah, this is the kind of geek I am. I was like really enjoying setting this presentation up for you guys because I'm just that kind of geek. Where I actually enjoy being able to go, okay, how do I bottom line economics? How do I give you the most important points, right? How do I make it so that it's usable and yet informative, grounded in data and facts so that you understand why you're making the decision that you're potentially going to make? Because that's, to me, an informed decision is the best we've got. It's who we cultivate ourselves to be as professional investors is by making informed decisions. So being informed, my network helps to inform me. I use Google a lot to inform me. I use Fred. I use Business Insider. I use Tuesday morning charts. I use, there's another series of charts I used a lot in this particular presentation. UCLA, right, their update. Marcus and Millichap, their update. Bruce Norris, Robert Campbell. There's a new favorite guy that I've been using, Ken, I always say his name right, wrong, Ken McElvoy. So these are all the people that I follow and listen to and try to get informed from. If I sound smart, it's because they're smart. All I'm doing is I'm just a really fancy parrot, and all I'm doing is putting together the information they have, and I'm sending it to you guys in a way that I can use it and synthesize it for my own investments, and hopefully you can use it for your own investments. So who am I? So that's me. I am a mom. That's really my first identity, is being a mom. My daughter is now 12. I think this picture was taken when she was 9 or 10. And that's my husband, myself, and I on our living room sofa taking pictures because I was supposed to look professional. I was wearing my whites. And that's really my why. It's really based in why do I invest in real estate is so I can be a mom. I invest in real estate so I can pick up my daughter from school. That's my why. And it's really kind of that simple. And I kind of don't know what my why is going to be when she no longer needs me to pick her up from school. I'm just going to have to find a new why. But really, I mean, it's also about heritage and legacy and leaving her something. And, you know, the other day I was describing to her about doing Airbnbs, and we talked about doing an Airbnb on the beach level. And she's like, oh, Mom, maybe we could do it this way. Maybe we could do it that way. And she said, Mom, I don't know. Is it too much to ask for an Airbnb for my birthday? I kind of went, I guess maybe I'm doing something right. She currently doesn't hate real estate yet because I try very hard not to shove it down her throat. But she's going to eventually be the receiver of a real estate portfolio because that's what I do. So I try to share it with her, but not shove it down her throat. And I love doing real estate. But let me be clear. I haven't always made money in real estate. This is sort of a new thing. I really want to put this out. Like, people have this perception, like people like me who've been in real estate for a very long time, we're full-time. I'm a full-time retired investor. I also am an investment advisor, which means I talk to people about investing in real estate because I love talking about it, but it's not my primary source of income. My primary source of income is my investments and the money I get from trusts. This is my primary source of income. I've lost $1 million in real estate, guys. That's part of what gives me the street creed to sit up here and give you an opinion, is because I've lost money and I've gained money, and I've gained more money than I've lost. It's like playing baseball, right? You want to be able to make more money than you've lost. And so if you've lost money in real estate, that is not a reason to stick your head in the sand. It is not a reason to give up. It is not a reason to decide you are a loser big time and you should just stop. It's a chance to double down and really test your inner metal in who you are as an investor, because we're here for a reason. We're here for the possibility of what real estate can bring us. We're here because we want freedom. We want control over our time. We want control over our integrity. We want to have choice. We want to live a rich life. What feels good to us? What feels good to me, what's rich for me is not our house. You can come to our house. Deborah, I don't know if you've ever seen our house, but you should see it. It's straight up 1950s, and my husband will not let me redo it. So it is old tile, old countertops. It's not being redone. Our abundance is my being able to pick up my daughter, my being able to choose my time. That is the highest level of abundance for me in my world. It's what I spend my money on. And you guys are here for whatever your possibility is, whatever your why is, whatever your understanding of abundance is why you're here. And that's why we're going to listen to 45 minutes of very, very boring economic information, which I've tried to make interesting, but I can't promise I was successful, so that you can make informed and educated choices on where you want to go in your real estate investing, so you have your why, so you can fulfill the vision that's in your head about what real estate means to you. All right, everybody pumped and ready to go? Okay, Deborah's with me. Yes, Jenny's with me. Nika's with me. Yay! There's 5 people out there. I can't see you all. Thank you, Sheila. I can't see you all, but I'm glad that you're here and alive. So if worse comes to worse, if you guys get completely bored and Christina's completely boring, write down on that piece of paper why you're here. And maybe that'll refocus you on why you care about something boring in economics. I am not a CPA. I'm not a lawyer. I'm telling you 35 years of experience and my best understanding, but I'm neither one of these. So don't sue me and check out anything I tell you. Good? Okay, got some head nods. Real estate, what are we seeing? Is it a really awesome market? Is it a really spooky, scary market? What is it going to be? And I'm going to push my way. What just happened? That is not what I want to have there. There we go. There we go. Okay, today is a good day to leap. I mostly have that there because it is a lovely picture and a good reminder. I'm going to cover 4 things. I'm going to cover USA real estate right now and the interest rate increases, what that means. I'm going to cover California real estate right now, affordability, and a housing shortage that we're facing. I'm going to cover the US economy because all ships rise and fall on the tide. We do not control the economy. Last time I checked, the Fed did not call me to ask my opinion on what they were going to do with it. Maybe somebody else has a straight line to them, but I don't. Right? And the other is my version of the big picture. What is the takeaway you need to know? All right, US economy. What is the national market doing? Now, can you guys see my whole chart, even though in my picture, you guys are blocking it? Okay, cool. What is it doing? So what I want you guys to understand is this last little piece right here. You see that? That's what it's doing. It had 10.5 years of going up since we had our last major downturn, and we're still going up. The gray lines are recessions, guys. So we had a little bit of recession. Thank you, COVID. And look at the increase we've seen. That is exponential. It's also across almost all the cities. It's across the 20 city, the 10 city, and the national. They're all seeing that uptick, right? And it's been 13 years since the downturn. What do national markets do when they're moving? These are the last 3 major recessions that we've seen. What does real estate do? It generally goes sideways, but then recovers. And what's important is how are we moving as part of these cycles? And that's why we time real estate. That's why we have economic conversations. It's not because the line goes down and stays down for 20, 30 years. It's because it goes up, 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 and then it goes, whoop, sorry, you're on a roller coaster and you didn't know it. And that's the roller coaster we're here to talk about. All right, now, when you're talking about real estate, there are certain things that are considered indicators where they tell you where the market's going or what it's doing right now. Price is actually not your primary indicator. Volume is a better precursor to understanding what's happening in real estate than price is. Price is the effect of a variety of other things happening. And if you catch it at price, you're a little behind what's actually happening in the market. So sales, home volume, sales were down 2.7% from the prior month and 4.5% from a year ago, although sales price continued to rise, up 15% from 1 year ago. The housing market, oh, and there are 2 months worth of supply. Anybody understand supply? 6 months is considered a balanced market. So if we're at 2 months of supply, that's considered an incredibly tight market. If we're at 8 months of supply, that is not a tight market. 2 months means the sellers have the advantage. 8 months means the buyers have the advantage. So we're still seeing a lot of compression in the home market, but we're seeing volume going down. The housing market is starting to feel the impact of a sharply rising mortgage rates and higher inflation taking a hit on purchasing power. National real estate sales by volume. See the downturn, that little huge dip? That was COVID. But this is what we want to pay attention to now. Sales volumes going down. We just talked about that. It's a precursor to prices going down. National real estate months of supply. Remember, I just said months of supply. 6 months of supply is a balance point in the market. 2 months of supply means it's clearly still a seller's market, which means prices will increase. But you see here how months of supply, see all the blue arrows? Months of supply goes up right before the gray band. What's the gray band? That's a recession, guys. So if months of supply is going up, months of supplies are going up, wait a minute. Did I just see months of supply still going up here? So even though 2 months is incredibly tight, we're seeing months of supply is actually going up because it was just so blooming tight 2 months ago. It was less than 2 months 2 months ago. Now 2 months looks like a loosening. Even though 6 months would be balanced, it still looks like months of supply is starting to loosen. Aggressively? Maybe, maybe not. There's a lot of up and downs in here, guys. So what does it mean? We don't know yet. Okay, pending sales, another precursor indicator to change in the market. You see here all the downturns. This is from Trading Economics, a great website like Fred, but it doesn't have the gray streaks of the recessions in it. You can see here each one of these, the downward arrows are the recessions. There's COVID, this last one in 2020. And notice we have another downturn coming in pending sales. Pending sales is decreasing. That's three indicators that we might be seeing a downturn in the market. Now, new versus existing. Bruce Norris puts forward the theory that when new and existing price per square foot crosses or comes close to crossing, we're hitting a top of a market. Why is that the case? It's the case because if I'm so desperate for a home that I'm going to buy a stinker at the same price as a rehab, I'm pretty desperate to buy a house, right? So as they get closer together, it talks about how much pressure is in the market. Well, we saw that, but not right now. What we're seeing right now is a much bigger space. So that indicator doesn't say that we're at the top of the market yet. So where am I going to land here? But there is something else at play, our interest rates. That was the quote we saw at the very beginning. Interest rates are the things that people are worried about. Where are we going to go? 30-year fixed interest rate. Now, I have this slide here more as a way of giving you guys perspective, right? This blue line right here, this long blue line, that is 7%. In our history, previous to 2000, 7% was considered sort of the average rate, sort of the central benchmark. What were you going to pay for having a loan? Primarily, it was going to be somewhere above or south of 7%. It's about where you're going to land. We're still pretty below 7%. And I have this chart here, this blue chart, which you guys should be able to see, even though it's blocked on my page. This blue chart shows you what is the change in your payment based on interest rate. And the thing I want you to notice here, probably most important, is you can see that 1 or 2% doesn't make a big difference. You need to go from much lower to like a 12% before it really starts becoming a profound difference in your payment. So we're sensitive to interest rates increasing, but maybe we're not quite as sensitive as one would think. And as you can see, our interest rates are still pretty low. Historically, this is still a pretty low place. Let's take a little closer look at it. This is the uptick we're seeing, guys. See, 7% isn't even on this chart. I can't even draw the 7% line interest rate because it's not even on the chart. So yes, we're seeing increase in interest rates. Yes, it's startling. It's true. And we talked before about you actually need more than 1 or 2% to really start becoming significantly inhibiting people's capacity to purchase. And we're going to continue to see interest rate increases. I am going to get to what does this mean to us as an investor? I'm just giving you the data. Okay. Right. Head nods. People still awake out there? Thank you, Liza. I appreciate it. Tina, you're still awake, right? Okay. Called her out. There she is. All right. Linda, she is there with me. Thank you, guys. So let's go back. Hold on. I need this. There it is. Okay, it's hard to predict what rates might start to act as a brake on rising prices. Now, I did PDF this, guys, so that if you want it, Deborah will have it and you can get it from her so you can read the entire quote. Okay. What else do we need to know? Rates and home prices could well continue rising higher together for a number of reasons. Rates are going to increase and home prices are going to continue to increase together for a number of reasons tied to the higher inflation today. Rents are soaring. So rising rents in a context of an 8% annual inflation and a 4.5% mortgage interest rate, the 4.5% might look like a decent deal. Now, I have that in blue because I want you guys as professional investors to understand this dynamic, okay? Here's my payment chart, right? For every 100,000, I go from 4% to 6% to 8%. That change from 4 to 8, that's going to make me pause, right? That's a big change. But if it's going to go from 4 to 6, maybe that's not as big a pause as I would think. But let me show you what actually happens in rents. If I start with the same rental rate of $477 and I go up by let's see, all the way up to 12%, that's $515. Is that going to stop me? No, I need a much deeper rise in rents to be able to have rental increases be as meaningful as a mortgage interest rate increase. Why? Mortgage rates are principal and interest. So there's a much steeper curve there. So yes, rising rents are important. And yes, rising rents can go up 16% and have that space to go up 16% when you're looking at mortgage rates going up by 1 or 2. Do you see how the relationship can work? So I'm just trying to get you to use your brains and think through, yep, rents are increasing, but increasing rents may not force people back to buying until we start hitting 12 and 16% increases in rents. Oh, wait a minute. That's where we are. We're at 16% increases in rents. Okay. And the reason why I'm laying this all out is because we're moving into a particular space in our economy that makes a difference to us as an investor. Okay, see all my blue arrows? This is something you need to know as a professional investor. Kathy Fedke is the one who gets credit for teaching me this. Just saying, remember I stole a lot of other people's information. So this came from Kathy. Is my lights totally weird? I'm seeing myself now. My head's in the darkness and my chest is in the light. Okay, moving on. So the point is, do you see, remember the gray bars? The gray bars are recessions, right, guys? So what am I seeing? The effective funds rate. That's what they're playing with right now. The Fed is playing with the effective funds rate. They are increasing it. Does somebody notice what happens after every increase of effective funds rate? Is there a gray bar nearby? Do we see every time there's a blue arrow, we start seeing there's a gray bar and a gray bar and a gray bar right here? So what does increasing the effective funds rate do? It creates the possibility of a recession. Is it every single time? No, if we go back here in 1995, see, they increased the rate, but there's no gray bar. But there was the next time they increased it. So it doesn't happen automatically, but it does happen. If you count these, it's 10 out of the last 13 times they've increased rates, there's been a follow-up recession. So I'm just saying, percentage-wise, 10 out of the last 13, that's a pretty good chance that they're going to push this to the point where we see a slowing in the economy. The official technical definition of a recession, by the way, is 2 quarters of negative GDP. That's a half a year, guys. That's a half a year of negative GDP. That's not very long in our lives, so it may not be, it's meaningful. It's meaningful. But remember the chart I showed about what real estate does through a recession? It slows down and drops, but it comes back. So does the economy. Right? It's meaningful. Don't lose track of it. It can hurt you. It's hurt me. So let's not underestimate it, but let's not freak out about it. There is a pattern here that is understandable. So yield curve reversal. Anybody familiar with the yield curve? Deborah, are you shaking your head because you're familiar or you're not familiar? You're not familiar. Girl, you need to know this as a professional real estate investor. Let me teach you. Okay. What happens is you have a 10-year T-bill and you have a 2-year T-bill. You have interest rates on both of those, right? Generally, one would think that people have more faith in a 10-year than a 2-year, right? Long-term interest rates versus short-term interest rates. Well, what happens is if they reverse, that means people are more concerned about immediate inflation in the next 2 years than long-term inflation in 10 years. If the 2-year is higher than the 10-year, the market is speaking. It's not necessarily speaking fact, by the way, guys. It's speaking its confidence. It's saying, I think inflation is going to be higher in the next 2 years than in the next 10 years. That's a reversal. Historically, when the 2-year, 10-year yield curve inverts, a recession has taken place an average about 19 months later. And the percentage on this is 5 for 5. Here's the chart. You see a reversal, you see a gray bar. You see a reversal, you see a gray bar. 5 for 5. Right? We don't see this gray bar yet. This last one here, where we are, but it just reversed. So I've got 2 indicators here saying we're going to see a recession, but I'm not done with my conversation yet, guys. So just keep holding your opinion. I am building think of this as a debate team. I am building a conversation here. All right. And here's again, this is for you guys as professional investors. As you get there, you want to understand that housing supply, I have to figure out my notes down here, which are now being blocked. Stop being blocked. Go up. All right, I can't. That's okay. What you need to understand is that housing supply follows the funds rates more than actual prices do. Do you see there's a correlation here? These go together, these go together, these go together, these go together. So remember I talked about housing supply, months of housing? That actual months of housing is more closely related than the actual interest rate is related to the funds rate. So if you're going to use an indicator, that's why I like using housing months of supply on market more than price. Price is lagging. Months of supply actually correlates closer if I'm looking for a downturn. So has my months of supply moved? Yeah, it's starting to move back up again, but it's not there yet, is it? It's not doing this peak, that peak, this peak, that peak. So it's starting to peak. And here's what, and I'm going to let you in on the joke in a little bit, guys. I really am. GDP is also an indicator of real estate prices. Again, see, there's a correlation. So if we're looking for indicators, GDP and housing and months of supply is a better thing to correlate, and pending sales are better things to correlate than price. Price is lagging. Okay, let's talk about California for a minute, because that's where the next juicy bit is. California increases higher than USA almost all the time, every time. This particular little fancy, right? This little boop, we've seen it more strongly in California San Francisco, and in Denver, Colorado than we have in the US as a whole. So regional effects. If we're going to see a downturn, we're going to see a greater downturn where we've seen a higher tail. And this is the tiered, in case anybody wants to follow tiered, like if you do an upper tier flips versus lower tiered flips, notice they all have the tail. Okay, so they're all equally being affected by this, regardless of what tier you're flipping in. Okay, I'm gonna let Carr just sum up California. Shares of homes sold above asking price. 71.2% of homes are sold above asking price. Does that tell you some idea of the pressure? That's a lot. We've got 8 days of median time on market. We have an interest rate of 4.7%. So California prices and the momentum in California is still going. It's still moving. But we have indicators saying we're seeing a softening. We're seeing a softening maybe economically. We're seeing a softening potentially in real estate. The Los Angeles metro area, 9 days on market as a whole. Not just California, 9 days in Los Angeles. We're in a high pressure market, guys. Now, you probably know that. If you're looking to buy or you're looking to flip, you know this is a high pressure market. Affordability, another indicator. This comes from Bruce Norris. Bruce Norris likes to use in Los Angeles, he likes to use 17%. And in Orange County, he likes to use 7%. So you can see affordability has been going from 24 to 21 to 20. So it's been getting tighter. When this gets too close to 17, we start worrying. But here's something else. And here's pending sales, right? Another indicator, pending sales going flat. And so now I've got all these indicators. Now, if you're listening to me, you kind of go, well, it sure sounds like maybe we're looking at a softening, if not a downturn in real estate, Christina, at least in residential, right? Because I got a bunch of indicators saying that might be the case. Okay, I may look for some head nods. Are we still out there? We're following the thinking. Nika, you got it? Does it make sense to you? Okay, you guys will be able to ask questions in a little bit. Tina, you still awake? Liza, my girl, she's there. Okay, good. You guys are smiling and still awake. That's lovely. Thank you, guys. So I'm laying out a bunch of indicators to you guys as to where it's going to go, but I have this thing in my back pocket I'm going to bring up soon. Active listings are going down. Interesting. Pending sales is going down. Prices are going up. Things are flying off the shelf, and yet active listings are going down. You think people would want to be selling, right? Oh my gosh, I just sold my used car because used car prices are so blooming high. I'm like, this is a perfect time to sell my car and buy a new one. So I did. Right? I rented a car for a couple months. What do I care? Right? Why is that the case? Oh my gosh, the fly in the ointment showed up first. It's not supposed to show up first. It's supposed to show up second. The fly in the ointment. The fly in the ointment for residential is the supply of U.S. homes for sale is near a record low. The gap between supply and demand is widening. The U.S. is short by 5.24. I said 5 million homes, and is increasing by 1.4 million homes since 2019. The current number, by the way, is 7 million homes. We're short by 7 million homes right now across the U.S. The U.S. Census has found that 12.3 million American households were formed in January of 2013, but 7 new single-family homes were being built during that time. Math suggests, I'm thinking 12 minus 7 means we're still short. We're still short by potentially 5 million just since January of 2012. Single-family construction has suffered from severe labor shortages as well. So we're short 5.24 million. And homes, if they want to build homes to replace, they would have to double their construction rate. And then in 5 years, we'd have enough homes. That's assuming nobody else had any babies for the next 5 years. Okay, so in residential, there's something called undue influence. I've shown you in the national market that we're having potentially a downturn in real estate. But residential has an undue influence, which is part of why, if you watch the conversation I had with Deborah before I started this, which is by sector. If we're going to see a recession, remember I said, and you're going to see that in economics, if we're going to see a downturn in real estate, does that mean everything is fricked up? Well, maybe not residential, because we don't have enough units, period. So that is the fly in the ointment. And that fly in the ointment, the picture was supposed to show up after. Yeah, okay. I'm better at numbers than I am at PowerPoint. There you go. Now, all ships rise and fall on this tide. So let's take a quick look at the US economy, because like I said, Fed didn't call me to ask me whether they should increase interest rates or not. And honestly, they're not going to. Deborah, did they call you? Maybe you're in with the Fed. Did they call you?
I am not in with the Fed, and I would really like the government to lose my number if they have it.
There's only one person I know. There's only one person I know who actually got a phone call from the federal government, and it was Bruce Norris. He was actually brought to Washington to have a conversation with them during the last big recession we had. He actually got the phone call. It's not going to be me, ladies. I'm just saying, maybe it's one of you, but it ain't going to be me. So all ships rise and fall on the tide. And that's why we have to pay attention to this. When I've lost my biggest chunks, it's been for two reasons. It's either been my network, by the person on my team, or it's been just sheer, oh crap, the real estate market's falling apart. Oh crap, the real estate market's falling apart. There's a chance I can do something about that. And team as well, but Deborah has to keep coaching me on that one. So US economy, US national debt. Did anybody notice that the US national debt has had a big jump recently? If you haven't noticed, let me share it with you, right? Why? Because COVID, we put $5 trillion worth of value into the economy. That's what we did. You see the change, see the movement? This is long, even wages have gone up. Do you see wages went down? This is the amount wages went down during COVID. This is the amount they've gone up. Have they gone up more than they've gone down? Is that what I'm saying? Okay. There's a close-up of it. See the close-up? So there's been a distinct jump in wages. There's also been a distinct movement in our GDP. 2 quarters of negative GDP, right, guys? Notice first arrow is COVID. We all recognize that. The worst GDP, the worst movement in GDP we have seen since the Great Recession. Sorry, Great Depression. That's why they called it the Great Recession. Well, actually, that's not true. That's why they called it COVID. Great Recession was the previous one. I made a mistake. But here is what $5 trillion does when you pour it into the economy. Let's look at it a little closer. Negative 31 plus the negative 5, negative 40, we poured in 33.8. That was the effect of the money we put in, was 33.8. We've put in almost as much money as we lost in production. Now, I didn't put an arrow here, but if you look all the way over on the right, what do we know about our last quarter of GDP? Who wants to unmute and talk to me for a minute?
Is it because like there is no money put into the economy?
Right. That's exactly where I'm going. Somebody's been reading the news. Nice job. Exactly. What's happened? Let's dig a little deeper. Inflation. California Bureau of Labor. Right? So what has we seen in inflation? Supposedly the target is 2%. We would like to grow about 2%. Has something to do with, we all like to see money going up, but also has something to do with the fact that we actually have more people. There are more people born. And so therefore there's more demand. Therefore there needs to be more supply. Therefore to have the same amount, to make sure everybody has a loaf of bread when they want to buy one, we need to actually have more in the economy to do it. Right? So there's just growth. Like there's just vacancy in an apartment, in a multi-unit, There's just growth in the economy. That's just the way it needs to work, right? So here's been our big upticks in our inflationary rate. This is not the first time, guys. I want you to notice, see here, after the Great Recession, we had a huge uptick. See here in the 1980s, we all know interest rates went up to almost 18%, right? And here we are again. We're at the beginning. We're at the beginning, and nobody knows yet how deep this or how high this rabbit hole is going to go. Some say, if anybody follows the shadow statistics, some say that our actual inflation is greater, is not 8 or 9%, that our actual inflation is more like 12%. This blue line, which is the one I actually pay attention to, is the way that the CPI used to be calculated previous in 1990. That's when they had included things like oil and food. Then they considered oil and food to be too volatile. They removed them, and we now have our new official CPI-U index. Okay. Inflation by sector. So, and again, I'm building a case, guys. So annual inflation rose by 41-year high to 8.5% in March. I showed you the chart. We know where 41 years ago was, right? It was back in the 80s, right? Energy prices increased by 30%. By the way, Ukraine is one of the highest sources for natural gas, not for propane, but natural gas. And gasoline has increased by 43%. This is a chart I found. You can just look at it if you want. Look at it in the PDF. I'm not going to go through all the details here, but you can see there are a lot of things that have increased, including wages. Including wages. Okay, I'm going to move on. And there's our wage growth again, because I just wanted to remind you guys. Okay, so stagflation. Let me talk about a whole new terminology called stagflation. Maybe some of you guys know it. Liza probably knows it, I'm thinking, because she sounds like she's been reading, right? I suspect, Deborah, you know it, right? Nika, stagflation, you're familiar with the concept? Julie, right? You're familiar with the concept? Stagflation. What does stagflation mean? Stagflation is characterized by, and I just want to keep it simple so that it's not confusing, economic stagnation. That would mean negative GDP, accompanied by rising prices. Wait a minute. Did I just find out we have a negative GDP this quarter? And did I just find out that I've got like a zillion amount of inflation happening in my world? I think we're already in stagflation. I don't think this is gonna happen. I think it's happening. So what does it mean to us as investors if we're in stagflation? That's why I'm letting you know this case, right? So there's our negative GDP. Now I'm pointing at it. Okay, stocks and shares. I got to go through it. And the reason why I got to go through it is because how many of us own stocks of some kind? I own stocks. Liza, there we go. Jenny does. Absolutely. I can't see all your hands, girls. I'm trying to get there. Tina, woohoo, double-handed. Linda, she owns stocks. Stocks is part of our portfolio. If you're an investor, you can, and I do choose to consider stocks, some like Bitcoin, some like gold, right? Some like oil, right? As an investment vehicle. So stocks, but in this case, not only are stocks an investment vehicle, but also they are affecting the movement in the stock market is affecting our economy. So we need to pay attention to it. So here's what's been going on. Wait a minute, it's gone down by 11%. Anybody who owns stocks, we're real aware of that, aren't we? I looked it up and I went, oh crap. I actually had to calculate. I actually got my calculator. I went, wait a minute. Hey, that was a noticeable downturn. Let me calculate how much I've lost. Thank you very much. Right? It has gone down. It has gone down. Now, what was happening in stocks in August of last year, which was the last time I gave this update? We had 120 billion in monthly securities being purchased by the Fed. 120 billion. I know in relationship to our trillions of dollars of debt, billion doesn't seem like a lot, but it's enough. It's enough. 120 billion a month in securities in order to control the inflation in the market. and $80 billion worth of treasury securities and $40 billion worth of mortgage-backed securities the Fed was going to continue to purchase. That was in August. Notice what happened to stocks. They went up because the Fed was pouring money into it as a way of helping us make it through what was potentially devastating. I totally get it. Now, what are they doing now? The Dow Jones Industrial Average retreated 654 points or 2%. S&P dropped 3.2 and the NASDAQ slumped by 4.3. It's been over 11. I can tell you, I calculated it, right? The S&P is on pace to fall another 12% from here. Okay. So there is no picture available in general data or online that I could find a negative downturn arrow for stocks. So notice this one is upside down. That was how I got it to go down. I had to turn the picture upside down. So this is what it's doing. Okay. What is happening? What is happening in bonds? Bonds are countercyclical to stocks for those of us who are stock investors. The 10-year treasury yield rose to 3.2%. What does that mean? It means new bonds will have higher interest rates. Has anybody seen the new iBuyer bonds? Have you gone online to buy a bond online? They're offering 8.9%. You can only buy $10,000 worth, by the way, but it's 8.9% from the government. Just saying. But it means that existing bonds are going to go down in value. Be aggressive with interest rate increases. So the Fed Reserve tends to continue to be aggressive with interest rate increases and the reduction of its bond holdings. That reduces demands for bonds, lower their prices, lifts their yield. The same is happening in stocks. What's happening in Bitcoin for those of us who are Bitcoin investors? It went down 50% from its all-time high, guys. That took time for that to happen, but it's down 50% from its all-time high. But if you're also buying into company shares, those are also dropping as well, having to do with Bitcoin. And there's a whole list below. Keep in mind, it's hard to ignore what we're seeing and hearing other people forecasting. It's hard to ignore me saying, yes, guys, we're going to see a recession. Yes, it's going to be stagflation, but it's not going to be us heading into a 1973, 1974 scenario. What I showed you earlier, what does real estate do during a recession? It goes down, it goes across, and it goes back up again. We rarely see wipeouts nationally. Regionally, Las Vegas lost 85%. Nationally, we haven't seen wipeouts like that. Okay, stagflation. Market history doesn't do well in periods of stagflation. The market doesn't. Stocks don't do well in stagflation because they're rarely commodity based, but commodities do well in stagflation. What's a commodity we all love owning? Can somebody unmute? What's a commodity we all love owning?
Gold.
Gold. What's another
Gold.
commodity we all love owning?
Diamonds.
Yes. Guys, what's
Real
another?
estate.
Real estate. We all love owning real estate. It's a commodity, guys. When prices go up, when wages go up, which means inflation is long-term. By the way, this inflation is not a supply and demand inflation. It's called a push inflation. It's because the cost of goods have gone up. The cost of wages have gone up. The cost to produce something is more expensive. Things are more inflationary because they actually cost more to get to you. It's not because everybody's got so much blooming money that we're so excited to pay more. It's because it's being pushed onto us through the supply disruption and through wages actually increasing, through the actual lack of purchasing happening in the Fed. So the hyperinflation is systemic to the actual pushings behind the economy. Commodities go up in inflation, and real estate and diamonds and gold are commodities. Stocks are not commodities. US bonds will probably continue to go up because they're usually backed by something that's an actual real thing. A lot of bonds are based against like the government or muni bonds. They will continue to hold value. So now we're talking about how do you invest in a stagflation market? So now 60% of the investors finally agree with me. I was 6 months ago, at least, that I started going, I'm going to be arrogant for a minute. I said it was going to be stagflation. I did. I really, really did. Nobody believed me, but I said, It doesn't matter, guys. What matters is what are we going to do as investors, right? There we go. By the way, there's my stag for stagflation. So that there's no picture that says stagflation. There's no, I couldn't find one. So there's a beautiful stag in a beautiful countryside. Welcome to stagflation. All right. These are the big economic risks that everybody's talking about. Ukraine, COVID, oil, right? Oil crunches, China, overseas, even the pan-European is down, stocks are down, Tokyo stocks are down. This is not just national, we are now in an international market, guys. So if you're a professional investor, which I know you guys want to be, you want to realize we're not sitting alone anymore as a country. That's their conversation. Here's my version of the big picture. The Fed was keeping the Fed rate low intentionally. The Fed pushed $5 trillion into the economy. The Fed was buying bonds to support the economy during COVID. Now, the Fed has increased rates. The Fed has stopped buying bonds, and push inflation has hit due to COVID restraints and stimulus in the system. That's what I think is happening. I'm not focused on the Ukraine. I'm not focused on COVID, and I'm not focused on the price of oil. I know it sounds stupid, but I'm not. I'm focused on that we're seeing stagflation. Okay, drum roll, please. We're finally going to get to the reason why you guys are here. Hey, Lynn, welcome, honey. Okay. Funds is an indicator of recession. Hi, honey. So funds is an indicator. This is just a reminder. You've seen this chart before, right? We know Fed rate goes up. We know that there's 10 out of 13 has created a recession. We know the yield curve reversal, 5 out of 5 creates a reversal. So what's best to invest in? Marcus and Millichap. Thank you, Marcus and Millichap. They do really good research. I love Hashim. He is fantastic. If you have not gotten on the Marcus and Millichap email list, then please do. Just email them. I don't know if you can get on their email list from their website, but if you ever go to a meeting and you find one of these guys in a blue suit with a blue blazer, they're almost all Marcus and Millichap, and they almost always wear blue. It's their uniform. I don't think they require it, but if you've ever been to a Marcus and Millichap convention, you know they all wear blue blazers and light pants. That's what they wear. Get on the email list because you want to listen to their updates. Just like we listen to you, Deborah and I listen to the UCLA updates. I listen to Marcus and Millichap. I listen to Ted McAvoy. I sometimes can get Anderson. Arixa is an independent firm that I like to listen to. Bruce Norris, of course, Robert Campbell. So they did it for me. This is what you need to know. Surprise, surprise, or no surprise, multifamily and affordable housing has done incredibly well. And as I talked about, the fly in the ointment is it will continue to do well. It is not only has undue stimulus because there's not enough supply of it, it also is a commodity which will continue to do well in inflationary environments. Even though we're seeing a potential recession, I'm going to stand behind stagflation, which is an inflationary environment. So therefore, multifamily, single family, manufactured, all are going to do well. Housing and warehousing and distribution centers, industrial will continue to do well. People have been buying online. That's not going to necessarily increase. People have gotten used to the convenience of it. Industrials can continue to do well. On the other side, not surprising, lower tier shopping centers is a no, because lower tiered shopping centers often have in them the nail salon and the service places where you're going to need to wear a mask, but they're going to come back, but not necessarily this year. Given that we're looking at stagflation and people give up on luxury goods, luxury, right? Getting our nails done, getting our hair done, getting waxed, getting a facial, getting a massage, buying lots and lots of new clothes. People even stop buying washers and dryers. That's what people do when they cut back. So lower tiered shopping centers are not my favorite. Now, if you want to buy one in a couple of years, when you feel like we're at the tail end because COVID is done and stagflation is done, that's a different conversation. But right now, I don't suggest it. Senior housing, obviously hit badly by COVID, right? So But there is some interesting things that I found, which is student housing, storage. So what do you own? What do you own currently? Many of us are over here and we're in the housing area where there's undue influence and it's a commodity. It doesn't mean that your particular region isn't going to do well. But it does mean, so you want to still watch your region, but it does mean in general, these assets to do well. Hotels, they used to be the worst. They're now almost the worst. But Airbnb has replaced hotels. So I find Airbnbs are working. Again, it's a commodity and people are choosing Airbnbs over hotels. So I've tried to break this down for you guys by sector. I've told you the fly in the ointment. I've given you an idea of what are all of the things that I feel like are affecting us, why certain segments are going to go differently. There's Marcus and Millichap. Thank you, Hashim. You're fantastic. Here's my information. Let's do some questions.